Thank you very much for being here with me today. I care about financial education, and I've been at Haas teaching financial education to students, MBA students, undergrads, and PhD students since 2010. I love financial education because I feel like, especially my students, most of my students are not in finance, they're actually non-financial executives. And I think as those executives progress within the organization and they're getting closer to the numbers, they need to have a way to understand, to use financial data in creative ways to contribute more to the decision making. So I've been at Haas since 2010. I got my PhD at Yale back in 2010. I was there from 2005 to 2010. And as you can probably tell from my accent, I'm originally from Berkeley. So there's two core ideas that kind of summarize the way I think. The first one is that it's time to break the academic silos. It's time to move from analysis to synthesis. And what I mean by that is that we spend a lot of time understanding a particular discipline, accounting, or finance, or operations, or law, or computer science, right? But I think there's so much room for growth through intellectual arbitrage, basically talking to each other and exchanging ideas and integrating core principles across different disciplines, right? And what I like to do is talk to people in accounting, finance, law, economics, sustainability, computer science, data science, because there's so much to be learned by integrating these different disciplines. The other idea is the idea of moving from theory to practice. I'm an academic by training. 80% of my work is research, so I love theory. But at the same time, theory without applications is not very interesting to our students. So those of you who have been in my class, I always give you the framework. I always try to give you the rigor to think about things, to formulate questions and ask questions, but then I give you plenty of time to apply these ideas in practice. My cases are not like the ones you get from Harvard, where you get the question, and then you get all the information that is relevant for addressing the question. I think that's not how reality works. In reality, and you know that better than me, you have to come up with a question. And that question needs to be interesting, incremental, relevant to others, and you have to be able to communicate it to others in a way that makes sense. So what I try to do with my students is to give them a way to think and ask questions. And I promised them at the beginning of the semesters that I'm not going to have all the answers to their questions, but hopefully by the end of the semester, they have a great way to think about the world and ask interesting questions. So we're not doing the way Harvard does. We're doing it in a more interesting, practical way. So the questions that keep me up at night, many, many questions, increasingly more over time, because the more I'm spend time at Haas, the more questions I have from talking to colleagues and interesting in these different disciplines. But the first one is, how can financial education facilitate informed decision-making by non-financial executives, right? By effectively everyone, and help promote social welfare? How can financial education help promote market efficiency, the way the market processes information, promote price efficiency, and improve the allocation of capital in society? Because price inefficiency translates into capital misallocation, and capital misallocation translates into inefficiencies that can aggregate up to the macro level. By making prices more efficient, by improving the allocation of capital in society, hopefully, better ideas will find financing, and bad ideas will not get financing, so that everybody eventually is better off. The other idea is, how can financial data accelerate our transition to a more sustainable future? And this is something that I'm increasingly spending time with. And this is something that, again, the reason why I'm spending time is because students have been asking for this, especially over the last 5 years. In my class on financial data analysis and valuation, students have been asking me for ways to integrate non-financial data that is relevant for financial decision making. And one vector of data that is especially interesting is data related to sustainability, data related to the carbon footprint of a company, data related to the carbon intensity of a company, data related to future expectations of the transition of the company to a less carbon intensive production. So how do we integrate sustainability data with financial data to make better investment decisions today? So these are some of the questions I'm spending time with. Now, today's session is about we have to limit the scope because obviously we have 60 minutes together. So what I'm going to try to do today is communicate my perspectives on the future of financial education. Obviously, the reason why I'm here, I'm Berkeley Haas, is because I believe in the value of financial education. But at the same time, what I realize over time, financial education is becoming less accessible. Whether it has to be more accessible, it's becoming less accessible. And that is an issue, but something we can actually work on. So the plan for today is I want to talk about the stock market. I will be asking you questions, right, to keep you engaged. I'll talk about the price and value. What is price, what is value, how the two relate to each other, and what's the role of the market in terms of forming prices. I'll talk about the role of financial data analysis in the market setting where prices may deviate from value. And finally, I'll give you my perspective on the future of financial education. Excited? Love the energy. All right, so first day back in school, I want to take it easy, right? So we're going to start, gradually from 10,000 feet, and then we'll kind of complicate things. So we'll start with this unit of economic analysis, which is the corporation, right? Independent legal entities separate from the owners. Corporation has rights and responsibilities. Corporations have the right to own assets. They can enter contracts. Also, they have responsibilities to pay taxes, pay back their debt, but also be nice to the community and their employees and their suppliers and the customers. The shareholders have the right to participate in the profits, and one distinctive feature of the corporation is the idea of limited liability, right? Your obligations, your liability is limited to the amount of capital that you provided. Two primary types of corporations: private corporations, which is the majority of them, and public corporations, those whose shares are traded in one of the public markets. So the stock market is all about these public corporations. Now, what is the purpose of the corporation? I'll give you three options, and then we'll open it up for discussion. Do well. Make money for shareholders. Do good. Negative thing about negative externalities and positive externalities to the community and the environment. Do well and do good. What do you think? Anyone? Yes?
I think it's mostly do well.
Mostly do well. Anyone else? Yes? Maximize shareholder value. How do you do that? How do you create value? Make money by growing sales, but growing sales in a profitable way. And this is something we're going to get back to. So how do you actually grow revenues? And how do you actually manage expenses so that you can grow in a profitable way? So how do you actually do well? Well, you have to grow the size of the business, but you have to grow in a profitable way. What does it mean to do good? It means mitigating your negative externalities and maximizing your positive externalities. Now, to the extent companies are asked to internalize more of these negative externalities, and there is a push for that from investors, regulators, the community, more of these negative externalities that were not priced before might become increasingly value relevant, which means becomes the line that will be separating the do well and the do good might becoming increasingly blurry, hard to separate. I think a great example is the recent rules from the Securities and Exchange Commission with respect to carbon emissions. Right? The whole rationale behind the SEC final rules, there is nothing final about these final rules, right? Because they've been litigated and they're now on hold. But the whole rationale behind the final rules with respect to climate-related disclosures from the SEC is this idea that if companies disclose more information about the carbon emissions in a way that is verifiable, that can be assured by a third party, then investors might be in a better position to understand the risk of the business and come up with better forecasts of growth and profitability so that they can better, more efficiently price companies. And that's at the individual firm level. At the market level, the idea is that more disclosures with respect to climate might actually help investors price risk in a more efficient way. That can impact the way capital is being allocated, and that can impact the way we transition to a more sustainable economy. But the whole rationale behind these mandates around disclosures related to climate is this idea of efficiency and pricing of risk that has been perhaps not as efficiently priced up to today. Now, with respect to the SEC rules and regulations, these are on hold, but it doesn't mean that the market hasn't moved. The market has already moved. So I'm talking to many, many companies that are US companies that have global operations across different sectors, right? Not just technology companies, but oil and gas companies, oil and gas service companies, utility companies, right? Just cutting across sectors. Those companies that are big enough to have a global exposure, those who have exposure in Europe, they already have the obligation to prepare data in a very systematic way. To give you an example, I was talking to an oil and gas service company that generates 10% of the revenue in Europe. Even though they generate only 10% of the revenue in Europe, they have to disclose on a consolidated basis across all their operations globally their Scope 1 and Scope 2 and Scope 3 emissions. That is, not just the direct emissions of their company, but also the emissions that is being generated along the value chain. So for them, it doesn't even matter whether or not the SEC is going to move forward. It doesn't really matter, what the election outcome will be this year. That boat has already sailed, and if they want to continue to do business in Europe, which they do, they have to disclose more information, right? So the line separating the two is becoming increasingly blurry as investors are asking more information, and the market is trying to price more and more of these externalities. Now, so what is the stock market? Well, if you think of the stock market as a market for shares, and if you think of a share, it's a slice of ownership. So if a company has 100 shares outstanding, you own one of the shares, you own 1% of the company. Now, share ownership matters for two reasons. What's the first one? It gives you the right to participate in the value creation of the business, right? When you buy a share, you have the right to participate in the value creation of the business. That's one aspect. But what's the other aspect? Well, the other aspect is that if you buy a share, not only you can participate in corporate value creation, but you can also participate in the decision making. Because in many cases, one share comes with one vote. So shareholders can attend annual meetings virtually. You don't have to show up. And you can actually vote on key matters. Now, this is a very important aspect, the voting aspect. Most of us individual investors participate in the stock market through ETFs and mutual funds, right? That's how we do it. When we participate in the stock market in a passive way, which is perhaps the best way to participate if you're not in finance, right? Because it's diversified, low-cost exposure to the entire market portfolio. When we do that, in most cases, we abdicate our voting power. That voting power accrues to Vanguard and State Street and BlackRock and Fidelity. These are the asset managers that will be voting our shares on our behalf. Now, if you look over the last 10 years, more and more of that voting power is concentrated within 4 investment committees, the investment committees of the Big Four. With great voting power comes great responsibility. And what's happened over the last few years, and you see a push where individual investors are asking for more access to voting, more direct access to voting. And as a matter of fact, right now, Vanguard and State Street and BlackRock, they're running an experiment where they're opening up voting for millions of investors across many of their funds so that more of us can actually participate directly into the voting decisions, which is fascinating. It's an experiment. They call it the pass-through voting experiment, where they're passing through the voting to the individual investors. But it is a fascinating experiment because that kind of mechanism where millions of investors can come together and vote their shares, something that we couldn't do until last year. If that happens, it can change governance. It can really change the way corporations put issues up for vote, how they behave, and how they coordinate with shareholders. It can really change governance. So share ownership matters because it gives us the right to participate in value creation. It also gives us the right to vote our shares. And up until now, there was a disconnect between ownership and control, but that gap is changing. And as a matter of fact, there is several startups in Berkeley that are trying to streamline that voting process so that they make it easier for millions of investors to vote in accordance with their values in a very simple and automated way. Now, the shares can be sold and bought in the stock market. The stock market is a spiritual place where sellers and buyers are coming together and they're putting their money where their mouth is. It's fascinating. And we'll talk about prices and what is the price. Now, if you look at the size of the stock market in the US, as of now, it's about $51 trillion across NASDAQ, the New York Stock Exchange, and the American Exchange. So that's a big number. And just to understand how big that number is, we have to put in the perspective relative to the size of the US economy. So what I'm going to show you here is the time series evolution of the US stock market relative to the GDP of the United States. Now, the GDP is not the absolute measure of economic performance, right? But it is a measure that we have access to, and it is a yardstick that is commonly used. So let's see the evolution of the stock market relative to GDP over the last almost 50 years. From the 70s to today, the size of the stock market has grown. Actually, the growth of the stock market has outpaced the growth of the US economy. So it's important. It matters. Now, obviously, the economy is not the stock market, and the stock market is not the economy, but the two are correlated, right? But what you see here is that over time, the size of the stock market has really outpaced the growth of the economy. This is, so what you see here is any time of recession is usually preceded by a drop in prices, but the drop in prices is usually less persistent than the drop in economic activity. And this is something that became really evident back in March of 2020, where economic activity came to a pause, right? Everything kind of stopped across many sectors, not all sectors, right? So economic activity dropped, GDP dropped by 50%, but at the same time, the stock market went down and very quickly it rebounded, right? And that was a period of time where you can see the disconnect between the macroeconomy and the stock market. The two are not the same, but the two are correlated, and the stock market has grown over time, so this is important. Now, why is this important? Well, the size of the stock market has grown. The growth has outpaced that of the US economy, but the growth of the stock market does not accrue equally to everyone. So for people to benefit from the growth in the stock market, from the growth in stock prices, people have to participate in the stock market, because if you're not part of the market, you're not going to be able to enjoy the growth of the stock market. So who gets to participate? Not everyone. So we'll talk about the stock market participation gap, but before we talk about that, I want to talk about the stock market as an engine of wealth creation. So the simplest possible way to participate in the stock market is to buy an ETF or a mutual fund that is tracking an index. So I'm going to show you the evolution of the S&P 500 index, which is the most popular index over the last few years. So let's say 10 years ago, your uncle gave you a check for $10,000, all right? And then you took that $10,000 and you invested it in an ETF, an exchange-traded fund that is tracking the S&P 500. One of my favorite ones is the Vanguard S&P 500 ETF. The ticker is VU, and the management fees are very low. I think it's about $3 to $4 for every $10,000 of investment per year, which is fairly low. Now, let's say you invest in this $10,000 in the VU ETF tracking the S&P 500 index 10 years ago. How much money would you have today? Do you want to guess? Anyone? Much more. All right, so there would be growth. How much growth? Well, over the last 10 years, the rate of return has been about 12.5%. That's the average rate of return. Now, for those of you who care about the details, the 12.5% is not just the price appreciation, it's also the dividends. Because many companies don't pay dividends, but several large companies actually do pay dividends. And when you invest in an ETF, those dividends will be accruing to you. So the return, including dividends, over the last 10 years has been, on average, 12.5%. Now, obviously, this average is not constant over time. It's moving, right? Look at the volatility. Prices are moving. And prices are moving even more at times of crisis. That's the definition of risk. What is risk? Risk is uncertainty. Risk is volatility. And something is riskier if it's moving more exactly in the times that are more stressful, right? So you see at times of crisis, and that was March of 2020, you see even more volatility. But overall, the trend has been positive for the last 10 years. So the return has been 12.5%. And what you see here is the magic of compounding, the time value of money. So things are compounding very quickly because the $10,000 today would be approximately $33,000. That's 3.3x. That's pretty good. Now, one alternative, if you're afraid of the market, if you don't trust the market, or if you never had the dinner table conversations about the kind of access that today's investors can have, right, where you can invest in ETF tracking the whole market on your phone, right, by trading on Robinhood or Schwab or TD Ameritrade, anywhere. Let's say you mistrust the system, you don't trust the capital markets, you don't want to be part of it because of fear or because you don't have $10,000 extra to invest. Let's say over the same period of time, you took this $10,000 and you put them under your mattress. How much would you have today, 10 years later? $10,000. How much dollars are you adding? Zero. How many dollars you could be adding? $23,000. That's your opportunity cost. This is the alternative reality that you gave up by not participating, either because you were afraid or because you didn't know or for whatever other reason. That's your opportunity cost. Now, $10,000 10 years ago worth so much more than $10,000 10 years later. Why? Because everything got so expensive. And even though the inflation rate is slower today compared to what it used to be a couple of years ago, still prices are appreciating, right? And the growth in prices has outpaced the growth in wages. So things are tighter, but that's your opportunity cost. So participation in the stock market in a diversified way, while you're minimizing management fees, seems to have worked well for those who participate in the stock market. Now, I'm not advocating to start, investing in idiosyncratic bets. This is a strategy that is tracking the index in a diversified way while minimizing management fees. That has worked well for a whole generation of investors that had the chance to participate. Now, if you look at the participation data, this is data from the Fed. This is basically the rate of participation across different parts of the income distribution split by race. So let me explain. So here's the bucket of households that make nearly nothing, right? $10,000 a year. And this is the bucket of households where on average they're making between $200,000 and $500,000, right? So low income, high income, right? The blue bars is the rate of participation within white households. The orange one is the rate of participation within black households. There's two primary insights that are coming out from this chart. What's the first one, which is more general? The rate of participation increases with income. Does this make sense? Yes. Of course, right? Because how do you reach the point to invest? First, you have to have a job. So you have to have a source of income. Then you have to manage your income and gauge your expenses. So you have to budget. After you budget, you have to save. And after you save, you can actually invest. But to reach the point of investing, you have to have a job, you have to budget, you have to save, and then you can start participating in the stock market. And you see, Within the top range of the income distribution, about 54% of the white households participate. The rate of participation is less than 30% for the black households. So the first thing to note is that more than half of white households participate. How do we participate? My wife is not in finance. She's an architect. She knows nothing about finance. She has a new appreciation of finance after being married to me. But how does she participate? Well, at the beginning, when she was appointed at this architectural firm, she had different choices for her 401k plan, and she's making like weekly, bi-weekly contributions, right? She's an investor. She's an investor. And millions of others are investors. And even if you don't think like an investor, you're still investing because you're making choices, right? You're giving up opportunities. You make selections. And you are one of those, investors participating. So this is not active participation necessarily. This can also be passive participation through mutual funds and ETFs, right? So the first discrepancy is that across income distribution, the rate of participation increases with income. And the other obvious one is that the blue bar is always higher than the orange one. So the average rate of participation within white households is 3 times higher on average relative to black households. And the question is, why is this happening, right? So by the way, that chart was the motivation for a program that we started with PG&E two years ago. Either 2 years ago or 3 years ago, I don't remember exactly. But for the last couple of years, we've been working with PG&E, which is the last company that comes to mind when it comes to financial education. But what really made the difference there was that 2 executives that are very close to the top of the leadership in the C-suite that grew up in Oakland. They're both African American. They love their community. And they reflect on their lives. And they say, how did we end up here in a position of leadership? And they realized that some of their exposure to financial education early on, really basic stuff, actually had a profound impact to their lives. And they said, how do we give back to our community? So they reached out to us. So we're working with PG&E, and we developed a program on financial education for high school kids. So that's been happening for the last few years. It's been very successful and very impactful. But this is when I realized that even simple lessons around the time value of money, compounding, interest rates, managing student loan debts, managing credit cards, understanding credit scores, right? The idea of budgeting, investing, and ways you can participate in the stock market, if you have that exposure early on, it really makes a difference. So it really matters. Yes?
This chart, I'm wondering about the demographics, the stock market participation. Is this of existing accounts, or is this of general population information?
That's a survey of the general population. So the data can be skewed depending on who gets to respond, right? But this is the most credible data that we have so far, and it's coming from the Federal Reserve. But definitely understanding the gap and the reasons behind this gap is very important, and it's actually an inspiration. Now, if you think about the market mechanism, right? What the market is trying to do, what the market is trying to figure out is the price of everything, the price of every company. And that's a very complex exercise because if you think about the market, it's regulated, but it's also unstructured. And there is no centralized mind so far with access to all the information that people have in their possession. So the role of the market is to aggregate information that is otherwise dispersed in society. So not everybody has access to all the information, but everybody knows a little bit, and those who get to participate, they're putting their money where their mouth is, and prices eventually are reflecting the information that is otherwise dispersed in society. So the way I envision the market mechanism is really a telecommunication system that aggregates information that is dispersed in society and then disseminates this information back to everyone. So if you know something and you trade, that information becomes part of the price, and that price is now disseminating this information back to everyone. So if you start thinking of prices as a coordination mechanism, it's actually fascinating because prices have the ability to coordinate human action and impact capital allocation. So if you come up with a regulation, with a disclosure, with a framework that will impact the way people price risk, that will affect prices, that will affect human behavior, and that will impact capital allocation. Now, when it comes to price is what you pay, value is what you get. Now, if the market is efficient, price and value are about the same. So if the market is efficient, which means that if there is information that is relevant for valuation is incorporated in prices, what you pay is what you get. In an efficient market, on average, the price is right. Errors can happen, but those errors tend to be random and really hard to forecast. Now, in an efficient market, if a company has news about the firm, news about the industry, news about the sector, news about the macroeconomy, this news will be incorporated very quickly into prices. So for example, Apple has a new product release. This information, when it hits the market, needs to be incorporated very quickly into prices. Prices are adjusted in an efficient way, and the price reflects the value of the company given the new information. So if the market is efficient, the price is right on average. And even though the price can fail, those failures tend to be very tiny and very small, and you can actually ignore. So which means that if the market is efficient, our best guess of the value of a company should be the price. So if I were to ask you what is the value of Apple, your answer should be? If the market is efficient, then the price should be the best estimate of the value of the company. If I were to ask you what is the value of Alphabet, your answer should be the price. If I were to ask you the same question 5,000 times for the 5,000 listed companies, if you were to say, well, the value of company XYZ is the price, because on average the price should be right, well, guess what? On average, you would be correct. So which means that if the market is efficient, our best guess of value should be the price. Now, why is this problematic? Let me try to make the case in a way that I usually do in my class, which is, let's assume for a second that the market is perfectly efficient, which means that the price is right, which means that the price should be your best guess of the value. So let's assume for a second that the market is truly efficient. Now, if the price is right, you have to believe that the price is equal to value. Correct? Now, understanding or estimate the value of a business, it's a complicated task. Why? Because you have to go to the company reports, you have to get the accounting data, you have to process the data, you have to put it in a spreadsheet, you have to build forecasts, you have to estimate the cash flows, you have to discount those cash flows to estimate the value of a business. It's a complicated task. And there's so much more to life than running accounting data. So if you can get it all just by looking at prices, why not just do that? Just look at the price. Why would you spend any time and effort on financial data analysis if the price is right to begin with? Our time on Earth is finite. Time is infinite, but our time on Earth is finite. There is more to life than financial data analysis. And if the price is right, I'm going to use the price as the best guess of the value of the business. But hold on, right? If everybody thinks that everybody thinks that everybody thinks that the price is right, then what's the issue? How can the price be right to begin with if nobody cares doing their homework, right? Somebody has to analyze financial data, because if nobody analyzes financial data, if nobody tries to estimate how firm-specific news and industry-wide news and macroeconomic news and geopolitical news are impacting value, if nobody is doing that kind of analysis, how can the price be right to begin with? So a much more realistic perspective on capital markets today is that the market has to be efficiently inefficient. That means that prices have to deviate from value sufficiently so that people, financial analysts, investors, are sufficiently motivated to engage with financial data analysis. Because financial data analysis is not free. It requires data, knowledge, expertise, time, capital, human capital, right? So people have to be compensated for their time and effort, which means that a much more realistic perspective of capital markets is that the market has to be efficiently inefficient so that people are sufficiently motivated to engage. And that's a very interesting perspective. That goes back to something known as the Grossman and Stiglitz paradox. Grossman got the Nobel a few years ago, but that was one of the core ideas, which basically implies no matter how much we change, no matter how much technology improves or changes or evolves, there will be an inefficient degree of inefficiency in the price system that will keep people motivated enough to engage with capital markets, which I find fascinating. Because it says that we can't dismiss prices, obviously, because prices are aggregating information across millions of investors, but at the same time, we can't trust prices always. So now the interesting question is, when are prices more likely to fail? When is the market more likely to fail? So that's the next thing I want to discuss with you, which is, well, when it comes to market failures, what we know today is that these cases of deviations of price from value are not random. They don't just happen. It's not just like, a random act of nature. No, they're actually much more systematic. There's two places where we're more likely to see this kind of deviations. One is settings that are more speculative, which is very intuitive. A speculative setting is a setting where valuation is more uncertain. There is more disagreement across people as to what the value of the company might be or the value of the asset might be. So the first setting is speculative settings. Settings that are really hard to value, hard to understand. If something is hard to understand, well, this is a setting where there is more room for error. And if there is more room for error, there's more room for failure. Now, that's not enough, though. You need one more condition, which is you want settings that are also hard to arbitrage. And what I mean arbitrage is settings where sophisticated investors are less likely to engage and participate. Because arbitrageurs are those actors in the marketplace that are in the business of identifying mispricings, deviations of price and value, and then how do they live? How do they make money? They're trying to fight those mispricings. And as they close those mispricings, that's how they're being compensated for their time and effort. If they don't engage, especially in speculative settings, this is exactly when misvaluations, mispricing, market failures are more likely to happen. So if you combine these two, speculative settings with limited arbitrage, this is a perfect storm for a market failure. Empirically, what we see in the data is that the two conditions are actually correlated. Arbitrageurs are less likely to participate in super speculative settings, in settings where arbitrage is extremely constrained, extremely costly, extremely risky. So they're less likely to participate, and the market is more likely to fail. But who is more likely to participate in this kind of setting? Individual investors. Individual investors are more likely to be attracted to settings that are more speculative, where arbitrage is less constrained, more constrained. And that becomes an opportunity for financial education, because many of these individual investors are investors that have access to trading, but they don't necessarily have access to informed decision making. And what you see in the data, you see a transfer of wealth from the less sophisticated to the more sophisticated. Now, from a social welfare point of view, you can say it doesn't matter because one group of investors benefits at the expense of another group. But if you think of a systematic differences in the characteristics of these two different groups, then a social planner may actually matter. For a social planner, that actually can be relevant. So why is this important to me? That's important to me because what I see behind this asymmetry is an asymmetry in access to financial data and asymmetry in access to financial education. So what is the role of financial data analysis? Well, the way I teach finance at Haas is financial data analysis, especially in a setting where you can't always trust prices, is a way to tell stories with numbers. It's one way to look at the data, understand the story behind the price, but also tell stories with data. It's a structured approach to understanding the past of a company, an industry, a sector, an economy, a way to forecast the future, because how can you even begin to forecast the future if you don't understand the past, and also a way to manage uncertainty. With respect to the last point, that's very important because financial data is not going to give you a point, they will never give you a point estimate, a precise answer. They will always give you a range of possibilities. And that can be frustrating for some of the engineers in my class who expect yes or no answers, black or white, a number, 10, 12, 15, whatever. It's never like that. So finance and financial analysis, what allows you to do is estimate the range of possibilities, the distribution. And that's valuable because you don't know exactly what's going to happen, but at least you can eliminate things that may not happen or are very unlikely to happen, or try to quantify those that are more likely to happen. So really the way we think about financial data analysis at Haas is a way to understand the past, forecast the future, manage uncertainty, and more importantly, to tell stories with financial data and behind the financial data. Now, I do think that financial education, financial data analysis in particular, can serve everyday people, and it can really serve our students. And I think our students, what they're getting access to, especially those who are not in finance, is a way to contribute more to decision making, to understand the different parts of the organization. I see more in the audience. On Monday, we had a session. Is it okay if I share? Yeah, so on Monday, we had a session with Micron Technology. It's a multinational, multi-billion, critical infrastructure semiconductor company, right? So we had a session with insiders, most of them not in finance, and they were accompanied by their chief financial officer. So we had a joint session with their CFO. And what was the objective of the session? The objective of the session is to use data from their financial statements, and me as an outsider to the organization is to tell the story of Micron through the lenses of their financial statements, the way an outside investor would perceive that story. So really, that was a session on empathy, because now you had all these engineers who were trying to empathize with the outside investors. And that exercise in empathy is extremely important, because unless you understand how other people think about your company, how are you going to communicate the message of value creation? How are you going to create value if you don't understand what they're looking for and how they perceive you? So that was very interesting because I feel like, every time I do these sessions, I feel great for having an impact on these executives, but at the same time, I feel sad that they were not in my class a few years ago so that they can be more impactful later on. So it's a very mixed feelings because I do feel that everybody can benefit from a structured approach to financial data analysis, especially those who are not in finance. And obviously those who are in finance, they have to understand it. But I also think that financial data analysis, financial education can serve society and improve the allocation of capital allocation society and live a more sustainable future. Now, how much time do we have? How much? 20 minutes, perfect. We have enough time for an application. Okay, so we'll do an exercise together. And that's something I like to do with my students. Now, this application will be really a discussion around value creation. What drives value from the point of view of capital providers, right? Because any organization has investors, has other stakeholders, but for now we're going to focus on the perspective of the investors and how value is created from their point of view. But before we go there, there's a question.
Just can you clarify that institutional sophisticated investors, all investors, or individuals you're talking about?
Here it would be any. We're not going to distinguish between smart money and not so smart money, individual or institutional investors. We're going to pull all investors together. Because that's actually a very deep question, and I'll go back, borrow from the Micron case. If you look at the investor base, of most of the US publicly traded companies, especially those in the S&P 500 index, if you look at the investor base, about 20% of the shares are owned by institutional investors. Which ones? Vanguard, Fidelity, State Street, BlackRock. Whose interest these institutional investors are representing? The individual investors. So if we go back to your question, right? Whose point of view am I taking? Well, even if I take the point of view of the institutional investors, I might actually be taking the point of view of the individual investors, right? So that distinction at some level to me is, trivial in the sense that if you look at the public markets, the distinction between the two, the line separating institutional from individual is actually, that line is very blurry. All right, so let's talk about value creation. And I think the best way to think about value creation is, using a startup idea, okay? I want you to make a promise to me that you're not going to share this with anyone. It's going to stay between Haas, okay? All right, so here's the idea. You tell me what you think. I want to create a website. And that website, I want to be selling $1 notes. I have about $1 million of those, and they're here in the podium, hiding. You can't see them, but they're there. And I want to be selling each one of these dollars for 50 cents. Question number one, would you buy my dollars? Would you? Yes? Yes? Yes. Why? Why not? Why not, right? So if you get over my accent, right, and you start trusting me, it's like, yeah, these are, US American dollars, right? So these are real dollars. You pay 50 cents, you're going to be getting $1. So what is my growth story? Exponential, astronomical, right? It's a beautiful growth trajectory. Fantastic, right? Right? Is my pitch over? No. Because what's missing from the growth story? Here's the growth story. The profitability story. So let's talk about profitability. And the two are not disconnected, right? Growth and profitability, they have to be discussed at the same time. So what's my profitability story? Does it look like that? No, it looks like that. For every dollar I'm selling, I'm losing 50 cents. What is my net profit margin? Negative 50%. That's my profit margin today. What is my expected profit margin next year? Same, right? Unless I have no money left to sell. Because I feel like those dollars will sell like hot potatoes, right? Everybody should be willing. You should be willing to borrow money to buy my dollars, right? So this money will go very quickly if I'm able to fundraise and keep pitching, about my growth expectations and kind of my growth trajectory, and I'm able to fundraise, I'll be able to burn more cash, right? But what's my profitability path? Minus 50%, assuming that there is more capital to spend, right? So there is no path to breaking even, and there is no path to generate a return on capital that is higher than what? Whatever I could be earning, had it been the case that instead of selling my $1 million for 50 cents per dollar, instead, I could take that $1 million and do what? Open up a Robinhood account, funding with $1 million, and then put it at an ETF, like the Vanguard VU ETF, at $4 per $10,000 of investment, management fees, put in the VU ETF, tracking the S&P 500, leave it there for the next, 20, 25 years, I don't know how much time I have left at Haas, right? Leave it there for the next 20 years, and then retire in Greece, in peace and have a great time. In expectations, based on the past record of the market, which may or may not repeat itself, right? The rate of return would be about 8 to 10% if history were to repeat itself. So the alternative in this startup is negative return on capital, no path to breaking even, and no path to exceeding my cost of capital. And what is my cost of capital? What I could have done with my capital had it been the case that I didn't invest in the startup, in this terrible business model that is completely broken and there is no path to fixing, right? So let's summarize that. So when it comes to value creation, obviously you want to grow the business, but you want to grow the business in a profitable way. What is profitability? You want to generate a return on capital that is higher than the cost of capital. What is the cost of capital? It depends. The answer to all my questions is it depends. Right? The only value I'm adding as a social scientist is to provide a little bit of structure to think of it depends on what. So it depends on what? It depends on the investor. Who is the investor? Well, in this case, it was my money. Right? What do I have access to? Well, I don't really have access to the Silicon Valley startups. I still have access to Robinhood, and I still have access to the public markets. So that's a pretty good benchmark, right? But what if I was a venture capital investor? What if I was a private equity investor, right? My cost of capital would be different. Why? Because my opportunity set would be different. So usually the cost of capital of venture capitals will be much higher than a private equity investor, than a public markets investor, because the access to opportunities is very, very different. But the same idea applies. Grow the business and grow the business in a profitable way, where profitability is return on capital relative to the cost of capital. Growth per se does not create value. When I share this with my MBA students, some of them leave the classroom yelling at me. Half of them, they just start checking their social media. Some of them are upset and just never return to the class. It sounds like something that I just said something terrible, but then I go back to my startup example where I can actually engineer growth in sales by selling stuff at a discount, right? In this case, my dollars. I can grow the business, but in this case, I can't make the business profitable. So growth per se, just because you grow the business, that will not necessarily make the business value additive. But the same token, if you lose money today, it doesn't mean that necessarily you will be destroying value if you're investing in new technologies and amazing people that over time will generate that value in terms of margins and growth in sales. But just because you grow the business, that doesn't mean that it's adding value to the investors. Growth per se does not create value. Growth is a catalyst in the value creation reaction. If a path has a firm to a return on capital that is higher than the cost of capital, that's healthy growth. But if a company doesn't have a path to profitability in excess of the cost of capital, as in the case of my startup, that growth is toxic, right? It's not value additive. Now, when it comes to the price of any company, right, and in this case I'm picking Microsoft, because Microsoft has a capitalization of $3 trillion, right? The most valuable company in the US used to be Apple until recently, but Microsoft took over with the excitement about AI and the investments it's making in the space. So their capitalization is $3 trillion, which is a very big number. Do you know how big that number is? This is about 12 times the size of the Greek economy. That's pretty messed up. That's substantial, right? Now, one question that somebody could be asking is, what is the story behind this value? What is the story behind this price? And this is as of Friday, as of yesterday, right? So Microsoft was trading at $408 approximately, right? So that was the price. So if you want to buy a share of Microsoft, you will have to pay $408. And I think one interesting question one could be asking is, what is the fundamental story behind this valuation? What investors will have to believe in terms of what? Growth and profitability, so that the price today is justified, right? Because the price is not just a number. Do you see the price? Not just a number. If you look behind that price, it's actually a collection of stories. Millions of investors are coming together, some of them more sophisticated, some of them less sophisticated, some of them institutional, some of them individual, some of them domestic, some of them international. They're all coming together, and they're putting their money where their mouth is, and all these different bits of information they have access to, aggregates up to that price. And when the market is open, the price is moving as new information is coming to the market. And as investors are updating, changing those beliefs. But the price is not just a reflection of what happened in the past. It's also, actually primarily, a reflection of what investors expect will happen over time, right? What investors anticipate will happen over time. And of course, those expectations about the future are anchored to the past, informed by the past, but it's not just about what happened, but what investors expect to happen. Okay? How do you tell the story behind the price? Well, if you were to take my class at Haas as a full-time or EW MBA student, and we spent 15 weeks together, 15, 1-5, that's a very large number of weeks, right? If we were to spend a whole semester together, by the end, it doesn't matter if you were a financial executive or a non-financial executive, you're a finance major or not a finance major, by the end of the semester, you will know how to source the financial data, combine the financial data, and estimate the value of the business from scratch. It doesn't mean that your valuation estimate would be high quality, I can't guarantee that, but you would know how to do that, right? How to at least set it up and start inputting everything to the system to come up with an estimate. And usually when I do this exercise in class, I end up with different estimates because different people have different beliefs. And that's obviously a feature, it's not a bug, right? Because when it comes to any company, right, not everybody will agree that this is the value of the business. Different people will have different beliefs. Different analysts will have different beliefs. This is kind of the consensus across all investors, right? But different people have different beliefs, and I say that all the time in my class. If you were in my class, you would know how to tell the fundamental story behind the price. But most people are not in my class, right? I only have, 300 students a year. Only. It's a big number for one guy, but this is a very small number compared to what's happening out there. So most people will not come to Berkeley Haas. We would love to accommodate all of them, but that's not happening yet. Right? It's not happening yet. So most people will not be taking classes like that. So how do we make it more accessible to people? Well, over the last 15 years at Haas, working primarily with non-financial executives, I had to automate things, simplify things. So what we built over the last 15 years is we automated all the boring stuff with respect to financial data analysis. So what is boring from the financial data analysis? Sourcing the data, cleaning the data, curating the data, standardizing the data, and working with spreadsheets. Our students don't like spreadsheets anymore. They don't like financial statements. They like easy access so that they can focus on more interesting stuff, which is totally fair. So the burden is on us to make it more interesting and more accessible. And the way to do that is use technology. So this is where finance and accounting and economics are meeting, computer science and data science, because now we have the tools to aggregate data and curate data at a very low cost, right? And take care of all the boring stuff so that the more interesting stuff become more accessible. In my class back in 2010, every time I would try to value a company, literally we would spend like probably 95% of the time doing the stuff that you don't have to be a Berkeley Haas MBA to be able to do, like downloading 10Ks and 10Qs and getting the data and working the spreadsheet. That's not interesting. Anybody can do that with a little bit of training, right? What is more interesting? Insights, right? So we have to automate all the boring stuff so they actually get to the insights. So what we've done is we built a platform that is accessible to our students for free. And that was, I released last year for the first time, and we're still improving, where we start with the price, and we get the prices in real time, and we have all kinds of collaborations. And then we try to tell the fundamental story behind the price in an automated way. So in other words, what investors have to believe over time in terms of growth and profitability for today's price to be justified. So that's one thing, because once our students start getting into insights into what investors think, then you know what they want to do? They want to do what they do best in life, which is criticize other people's forecasts, right? So one way to do that is to allow them to change the parameters and say, well, investors anticipate over time growth for Microsoft in terms of revenues will be 9%. What if it's 10? What if it's 11? What if it's 8% or 12%? What is the range of possibilities? We can codify that and enable them to experiment with these parameters without having to build the models from scratch. Now, what that enables a lot of our non-financial executives and students is to actually experiment with many, many, many companies, and companies that are familiar with. And this is something that they couldn't do if they were just to use spreadsheets. Most of our students, they graduate, and they don't have access to Bloomberg, FactSet, and other data aggregators. Most of them, they will reach out to me asking sometimes for data, right? And they were getting a lot of the information from Yahoo Finance, which looks like a website from the 90s, right? Same for Emerson Mine, it looks spammy. And there's so much crap on the side, I don't even know what's happening, and I'm supposed to be an expert, right? But how do you make this more accessible? And I realized that the only way is technology, right? And enable students to access data in real time, see what other people think, and then empower them to do their own analysis. So that's the idea, and I have 5 minutes left. So financial education matters, right? It matters for insiders to organizations, it matters for outside investors, it matters for every informed citizen needs to have an understanding of finance so that they can engage in more productive ways with their community. And I think financial education matters. It always mattered, but I think, and that's my personal view, it matters now even more. Why? Because access to trading has never been more easier. So everybody can start trading very, very easily. The younger generation of individuals, many of them have accounts, many of them trade, and many of them participate, and they have access to trading without necessarily having access to financial education. Now, access to capital markets, I think, is a great thing. But access to capital markets without access to financial education, that combination, I think, is becoming problematic over time. And financial education is not getting any cheaper. I've been at Haas for the last 15 years. I've seen the rise in tuition, right? I know that we're becoming more expensive and more selective, which means that there's many, many people out there that don't get access, either because they don't make the cut, because we have limited supply, or because they can't afford to do so, right? But at the same time, we have millions of investors participating in capital markets. About 20% of stock market participants today, they started participating in 2020, which is a very big number. There's a whole new generation of investors. And then we have about 75 to 100 million brokerage accounts across major platforms, right? So many people engage. Many people started engaging in 2020, and many people continue to engage. But access to trading is not the same as access to informed decision making. Just because people can trade now easier than ever before, that doesn't necessarily equate to access to informed decision making. So how do we make it more accessible? And what's the inequality here? Well, the inequality is that you have institutional investors that have access to data and models, and then you have individual investors that don't have the training, that don't have the access, right? And people, I think, are hungry for much more inclusive financial education. And this is something that, so when PG&E approached us to build this program, I was like, PG&E? But then I realized it's the people behind PG&E that happen to be there. They could have been somewhere else, that happened to be there that saw the same issue that we saw about access and equality to financial education, the value of that, and how that issue compounds over time. So I feel like the time is ripe to combine finance, education, and technology to bring the power of financial education to everyone. And I think it's straightforward. It's straightforward, right? Because we have the technology, we have the data, we have the processing capabilities, and the cost of processing is coming down over time. Which is very interesting because at the same time, the cost of Berkeley to Bloomberg and FactSet is actually increasing over time. So as processing technology is coming down, what we pay them actually, pay data vendors actually going up. Why? Because they realize that there is value to data aggregation. We can replicate to a large extent what they do to cover the needs of our students, but what they've been doing is that they take every little data set and they create a new product. and the price independently. And now I'm seeing how many millions of dollars we spend every year to get processed data that are in the public domain. I'm like, why are we doing that? This is taxpayer money that we could be using for financial aid, and instead, we use it to get transformed public data that we actually know how to do that. So I think there's a massive opportunity here for Berkeley, and that's something I'd like to share with you. Some of my students in the audience already have access to. This is an application that is accessible to everybody for free. No advertising, no tracking of personal data, no hidden fees, nothing, right? This is a platform that I use for my class for financial data analysis. Instead of writing a textbook, I built the app, which has become a living, breathing, evolving textbook with a lot of information that we're currently building over time and we're improving. So if you have any feedback, I'd be more than happy to hear it. What's up with the name? What's up with the name? I was looking for a name. It's very hard to come up with a name, but in terms of the timeline, what happened is it was March of 2020. March of 2020. I remember I had to transition. Adriana, were you in my class on Zoom? You were in the class? In the live class. So, okay, but in that year, one day we had in-person class. The next day we were asked to transition on Zoom. I was like, oh my God, how do we do that? So we started transition. We do it very successfully. It's Berkeley, right? We're very agile. We did it successfully. But then something very interesting happened. Robinhood exploded. GameStop was just going to the moon. You had all these meme stocks emerging, right? And I had many of my MBA students reaching out to me saying, Panos, you're wasting your time. Financial data analysis doesn't matter anymore. Everything is moving up to the moon. You only live once, right? YOLO. Why are you wasting your time teaching the stuff on Zoom? It's so painful. Do something else with your life. And I'm like, oh my God. It's like, this is why financial education matters. And then now, that moment, I feel like it matters so much that I actually had to do something about it. And in the moment, technology felt like, the way out with respect to everything. We're transitioning on Zoom. Let's build a platform to engage students, and that's when we started. So we started in March of 2020, and we started not with the idea to tell students what to do. I don't like doing that, and I think my students can attest to that. I never tell students what to do or what not to do. I just want to empower them, give them the tool, and then make more informed decisions, right? So the idea was to infuse a little bit of wisdom, the wisdom of the owl, in this YOLO mentality, and that's how we put the W in the YOLO, and that's how the owl emerged. I know it's a long story, but it's actually meaningful to me and my students because it didn't just happen. That was a response to something that my students have been asking for. Our students are asking for more access. And I think those who could have been our students, they're also asking for access. So hopefully technology and the intersection of finance, accounting, data science, and computer science will provide a way to reach a broader audience. I think that would be a very Berkeley thing to do. So we're right on time. I want to thank you for being engaged, for coming back to school, and I want to encourage you to stay connected to our community. Okay?